So were they refining the deal, or they just
They were going
down to what?
They were going to refi, cash out.
How much down to how much equity in the deal left?
None.
Okay. We're live.
Fantastic.
First podcast guest, Bill Langfitt. Some people call you the Duke of Debt, Lieutenant Leverage, the Equity Evangelist.
All people that love me.
That's right. But some people call you the best lender on the beach, which is pretty common, I think.
It's I don't know if it's common. It's been a long time. It's been a journey for sure.
Yeah.
I've learned a lot. I've had a lot of good people around me who've taught me, everything that I know about banking.
Yeah.
So,
Well, all jokes aside, people do call you the best lender on the beach. You're one of my best friends, and I appreciate you jumping on. So, Bill Langfitt, this podcast, this episode, going to be a little bit more focused on the lending side of real estate, which you guys can be crooks or robber barons, but for most of us, you help us put all the deals together. So, a lot of things go into finding a good banker, structuring the deal, stuff we talk about every day. So, I've got a bunch of questions for you, but before we get rolling, give us an overview about your history in banking, how you got started, where you're at now.
okay. I started in banking in 2001. Worked for a bank called Coastal Federal Bank. Started on the retail side of the bank, opening checking accounts, doing car loans, home equity lines, anything that someone on the retail side would want.
Right.
I was happy to give. Did that for about a year and a half. Moved to a small business banking role, which I really enjoyed. Knew I wanted to go that route mostly because the guy that I was working for as a retail banker
Right.
was in that world. Got to play golf a lot on Fridays,
Sure.
and I thought, hey, I'd like to do that too.
Yeah.
And I felt like growing up in Myrtle Beach, my background in just being, a native here, that I'd have the opportunity to really grow on that side of it. So did that for, probably another 18 months, and ended up moving from Coastal Federal to another community bank called Horry County State Bank as a commercial lender. And unfortunately, in the banking industry, in order to move up, whether it's in role or compensation, a lot of times you have to change banks. And I've not done that a lot in my career. After Horry County State Bank, I went to Crestcom Bank.
Mm-hmm.
And Crestcom was acquired by United Bank. And United Bank is a bigger bank. At that time, it just didn't feel like something that I wanted to be a part of. And so I left, and I'm with Anderson Brothers Bank now, which is another community bank in Myrtle Beach. But my entire career, I've been right here in Myrtle Beach, South Carolina. I've worked between 29th Avenue North and 44th Avenue North.
Right.
Yeah.
So what were the role differences at Crestcom, which then became United, and then now you're SVP? Were you SVP at those as well?
So I was an SVP at Crestcom. Anderson Brothers Bank doesn't have an SVP designation. Right. It's VP, and then it's, EVP.
Sure.
Actually, there's a regional president title, I think, in between those two. So the role really has not changed. As the title has, the role is to try to get your customers what they need in a way that's fair to them and then also fair to the bank. We all want to win, so you try to create win-win scenarios, but you want to make sure they get in the right product type.
Sure. And for this podcast, and for me, obviously, specifically, more looking at multifamily lending, run through, some of the, I guess, channels or folks you would typically lend to. So you do development deals. You also do new construction for land deals as well. Mm-hmm. Then you also do multifamily, hotel deals you've done in the past too. What other individual verticals do you lend to?
So, if you just want to focus on the retail side, on the real estate side of it, then anywhere from land development to you're taking raw land and you're going to develop that into either single family residential lots or townhome pads. You could pivot from there, and a customer's buying something that already exists, whether it's a commercial building, a hotel, where they might buy the hotel and need to do a PIP or what's called a property improvement plan, which a lot of the bigger franchises will require you to do when you're a new owner, or whether it could be a restaurant. I mean, anything in real estate, on the real estate side, I will touch, and I have touched. Real estate's not all we focus on because it's not all of what the customers need. So, right. I mean, it could be a car loan, it could be an equipment loan,
line of credit.
It could be a concrete plant in Colombia. I've just got done doing one of those. So
right.
That was actually the first concrete plant I've done.
Was it?
Yep.
Any asphalt?
Not done asphalt. No. This customer, though, is in the asphalt business. I just haven't had the opportunity to do anything on the asphalt side for them.
So before we get into the structure of deals, how do you get a good banker, how to be creative with your lender, or even finding a good lender, what most interests you? What do you like most about banking as a whole?
It's a good question. Looking back over my career, I know what I love about banking is I get to learn, a little bit to a lot of things. So as I mentioned, whether it's, it could be a restaurateur or it could be a beachwear retail company. It could be the A&D piece, hoteliers.
Right.
You learn a little bit about the full gamut.
So transitioning into one of the things we talk about all the time, which is the importance of knowing your lender and finding a good lender, right? And as you mentioned to me, when I first got started, it was when shit hits the fan, or if we have something similar to 2008, or your deal goes underwater, or you just have a poorly structured deal. It's always nice to sit across from your banker. So that gives people like you, commercial side, local banks, a competitive advantage. How do you find a good lender? And like, what for investors, guys putting together development deals or maybe multifamily deals, what should they be looking for in a lender, and how do they find them? A good partner.
Oh, man, I think you just have to ask questions.
Yeah.
I mean, you've been really good about that. You ask a lot of questions, and really it challenges a banker to kind of be thoughtful with their answer, think through that. Is there something in the question that's maybe you didn't say, because that's as important as what you did say, right? But so my boss from Horry County State Bank, he told me, and I'll remember this until the day I die, nobody needs a banker when times are good. Anybody can be a good banker when times are good. And then to kind of piggyback on that, my chief credit officer from Crestcom Bank would always ask the question, what do you get paid to do? And the easy answer is, well, you get paid to lend money. Well, that's not true. It was never the right answer. It was a trick question.
Right.
The answer is you get paid to think. And so when times are not good, you need to think. When times are good, you need to think. Because if it's true that everybody can be a good banker when times are good,
sure,
then what is your competitive advantage? Well, you have to outthink them. You have to outthink the other bankers. Sometimes you have to outthink the approvers to try to help present them what they need to see,
right,
instead of what they think they want to see.
Outthink in what regard?
Deal structure. Just how can you be creative? Sitting down, having the mutual conversation, trying to find the we call it the boogeyman.
Right. Yeah.
Maybe something that you haven't thought of.
That's what we're going to get to.
Could be something that I haven't thought of that maybe you did, and we collaborate on that.
Right.
And find different avenues on how to work out of what potentially could be a problem.
So to piggyback on that one, let's say I'm new to the area, or I want to get a local lender, or I'm trying to do a real estate deal. In looking for a good lender, how do I identify who's not a good partner for me, or like what is not a good match? Because you come across, just like any other sales job, you as a banker are going to come across someone who's not a good fit for your bank, or you can tell the red flags. What red flags could, without throwing anyone under the bus, what red flags could the investor look out for in a bank, in a specific lender that he goes out to the lunch and he gets to know them? What should he be looking out for?
So I think that an investor should always be wise to someone who is quick to say, yes, I can.
Right.
Right. Because you don't want a banker who's going to overpromise and underdeliver. You want someone that's going to, again, be thoughtful in what the deal is that you're looking for. Think about it, and hey, if I'm an investor, and I've done it before.
Yep.
I'd rather a banker say, let me take all the information that we've talked about, put pencil to paper, and I'll get back to you tomorrow. Make sure you call me tomorrow if you say you're going to.
Yeah.
Because if you call me in 2 days, you've already lost my trust.
Sure.
Right.
But that same process is certainly done on the bank side, but that same process should be done on both sides, right?
Yep.
I think courting in any regard, but courting a partner, whether it's even a law firm, and I want to talk a little bit about that too, but on the bank side, right, like you said, it's easy to say yes to everything. It's also easy to kind of do that from the investor side, but taking your time to make sure it's the right partner is super important. One, to me, on the investor side, because you have to work with the banker for quite a bit of time. Then you got to work with them on the refi too, and 3 or 5 years. So switching gears to, one last thing on the finding the good relationship. How many, and this is something we talk about a good bit too, not just having one good banker, one good partner. I think it's critical that underwriting any deal, putting any deal together, it's a business risk for you as the investor, unless you're just doing one-off deals. To have a pipeline or a sequence of good lending partners, because one, when you do get the deal, not only should you be shopping it, we can talk that too, but also you run the big risk of you guys don't want to lend any more money in the multifamily space, or this deal puts you over your exposure with this one investor. So what's the importance to you? Even though it takes money out of your bank's pocket, what do you think the importance of that is? Having multiple lenders.
So selfishly, I want to be able to do every loan that my customer needs. However, and I've mentioned this to you in the past, part of being a good lender is becoming a trusted advisor. So it's not just a banker.
100%.
It becomes, hey, it could blossom into a friendship. A lot of times it does, especially in smaller communities. Not that it can in bigger cities, but I think smaller communities lend itself to that more so maybe. So, it's not just about the banking piece. You want to do what's best for your customer. And so a lot of times that could mean having a plan B. From a lender perspective, you're right. There could be certain terms which we talked about. I want some extended terms on this.
Right.
Hey man, I know I can do that for you one time and maybe twice, but it's not going to be
not 3.
It's not going to be something that we'll just do over and over again. So it's probably a good idea to meet someone else that can be that backup for you. And look, if that's a good lender as well, then I think that they could also provide you with different services. For example, hey Bill, do you know a good attorney in town? I know a couple.
Yeah.
Let me tell you who those are, or different professionals that you might want to know.
Yeah.
But look, I don't want you just to rely on me.
Yeah.
So if you have another lender, they're going to probably have different folks
Sure.
that they can refer to you as well. So I think that's helpful too.
I think so too. That was one of the biggest talking points, and I think the biggest thing I've learned from you, albeit some direct and some indirectly, starting any business, starting to invest in real estate for me, right, as a business. What else can the lender do for you? And you touched on a little bit there, but from you, I've met builders, I've met other investors or equity guys that want to do a deal, or debt guys, or an attorney. Listening to other podcasts, being around just other younger, so to speak, investors, you don't really get exposed as much to that. People don't say, oh yeah, go meet a banker and then you'll get to meet everyone else. And to me, that's 100% now my playbook, which is take any guy that comes to me, and from there it's like, okay, who else do you know? I do that well, naturally, I think, but for the bankers, they know everyone very, very well. They know their client book, who's doing well financially, who's not, who likes to partner on other deals. Where you're looking at someone's entire financials. That guy's probably also telling you, hey, I want to invest in this, or do you know? So to me, that's a huge avenue that I don't think a lot of investors really explore as well as you've kind of shown me. So how do you think that's a competitive advantage for you as a banker for your clients?
I think I'm going to answer your question.
It was a long rant. Yeah.
So let me backpedal a little bit. When I got into banking and I decided this was the career that I wanted, I started thinking about just very simplistic things like, okay, if you get sick and you're talking to your buddy, hey, I've got a cold, hey, go see my doctor.
Right.
My doctor's the best. Or, hey, go see my dentist. Go see, you looking for a church?
Right.
Come over here to this
church.
Go
with David.
Yeah. Go with David. And so I wanted to develop myself into the banker that when people are talking about, hey, you need to go see my banker.
That's right.
Because I think that if you do that correctly, then you've you've really paid it forward to the point where your work is working for you through your customers in a way that you just don't have to beat the streets as hard, because you did a good job. You laid the foundation. You gave people what they needed, not expecting anything in return.
Right.
Right. I think you asked me one time, why are you helping me?
Yeah, I asked that. I'm very suspicious of that with everyone.
So
paranoia, Bill.
I help because I know that at some point, more than once in my life, a lot of times in my life, I'm going to need help. And people have helped me.
Right.
When I have had nothing to give back. So it just seems like that's the thing to do.
Yeah. It's a Southern thing to do. It's a Southern, us Southern guys, moving into this space that we probably speak about the most. So underwriting, we can break this out into a couple different ways, but for real estate investors, for multifamily folks more specifically, and I guess even for development deals too, underwriting can certainly mean a lot of things. We've got different versions of underwriting. When I'm getting a deal from a broker, his underwriting's different than mine, because the broker's one doesn't make me money typically, or it looks like it makes you money. And then the bank's underwriting can be a lot different than mine too, right? So what do you see as like the biggest ball dropped for just talking about real estate investing where do you see their underwriting coming up the shortest, or where do you always shine a light on that most people don't?
I think that I agree with you that there's so many different
Right,
ways
yeah.
to underwrite a deal, and the banks that I've worked for typically have their own templates that we use to underwrite deals, and we will say internally, and look, I think we say it externally too. What we have is not the best. Like it may be a lot more conservative
Right.
than it needs to be. And in most cases for a bank, you're going to find that to be true. Because, hey, let's be honest. You know, in a real estate deal like what we talk about, the bank is going to take 75% of the risk. Mm-hmm. So our underwriting should err on the conservative side if it's going to err.
Right.
I always say, hey, I don't want to be conservative. I want to be right. Mm-hmm. But I think we do find those, those templates to do that. And I think that could be where the bigger banks may excel.
Yeah.
Because they have people
Tighter
that are
process.
always, touching these different types of product types. Hotels are different than multifamily. Multifamily is different than a single tenant.
Right.
A single tenant's different than retail. Mm-hmm. Gross rents versus triple net.
Yeah.
All these things are different, and they change. I mean, they may not change year to year, but to be sure, they change over a 5-year period. Things just change. Mm-hmm. And so if you're not updating your underwriting templates, then you're stuck back in the 1970s.
Sure.
With something that's going to be ultra conservative.
Well, how does underwriting also varies wildly, even small local bank to other small local bank? You've been at 4 or 5 different banks in town here. Is the underwriting process not only different, but how you what fixed value you're going to put in for repairs and maintenance is different from bank to bank, I would assume, right? Does it vary a lot?
So in a lot of these templates, you'll find that some of the expenses are based on a square foot.
Right.
So there's a formula in a spreadsheet that says, okay, repairs and maintenance is going to be $1.50 a foot. Now, that's great as long as you get the right square footage in the cell above.
Yeah.
So if you don't have the right square footage, then it's going to throw off that.
Sure.
So it's only as good as the human that's inputting the figures in there. And so while some will be square foot, some will be a percentage of rents, and it all varies by product type, as I mentioned. So hotels will be different in their expense lineup than multifamily versus a single family residential. All those will be different. What typically is not different is you should know what the real estate taxes are.
Yeah,
you should know what HOA is if there's HOA fees. A lot of times you should know what insurance is as well.
Yeah.
So those will be figures where they'll say, okay, you need to put in the real number.
Right. So following the underwriting phase, the most crucial part, and especially for me, who favors leverage, you want to get the best terms. And everyone has the best terms that they want. That could mean different things to different people. For some, it could mean the longest AM, which I think is nice in some deals. But for others, it could be LTV. It could be rate and playing with this. So one thing that, and we obviously talk about all this stuff every day, it seems like, but how do you, the bank has a deal that they want to lend on, right? Standard. And for a lot of times it could be a low LTV or a lot of money down. For the investor, they may want the opposite of that. So I have my version of my best deal. The bank have their version of their best deal and what they'll typically lend on. What is the art and the creativity that people can put into selling the bank the deal, right? So something we looked at recently, taking a C-class property, bumping it to a B-class by getting a line of credit, to convert it, but doing an interest-only loan the first year until everything's done as a way of showing the bank, hey, look, we're actually going to use the money to convert this to a more reliable asset. Can you give us a longer AM? So using that as an example, what do you think people can do to sell the bank the deal? Because it's their responsibility to do that, right?
Yeah. I think the investor or the customer talking with their banker should have as much information as possible when they come in to paint that picture. So sometimes we see that where it's a very detailed budget. Like, here's exactly what we're going to do to upfit this property. And here's what we expect the result to be in terms of rent.
Sure.
And here is a feasibility study that we've done that supports what the result should be. But then you have folks who maybe don't have that detailed budget. Their timeline won't allow them to have that. Some of it could be because, like our buddy over there on Little River Road, that
Right. Yep.
sight unseen. Not sight unseen, but inside unseen.
Yeah.
So you don't know what you're getting. You come in and you do your regular deal with the bank. You're going to put your 25% down.
Yeah.
Maybe you ask for that interest only period. Maybe you don't. Sometimes they do. Sometimes they don't. If you don't tell the banker what your plan is, and it could be because you don't exactly know what the plan is, then it's hard for us as bankers to be able to help you structure a deal that's going to be the best deal for you, not knowing the plan.
Yeah.
So I say, make sure you've done your homework. You have as much information as you can get. Make sure that budget is as tight as you can get it. Not tight meaning, where there's no wiggle room, but good numbers.
Yeah. Yeah, I agree. I think that's the most of all aspects of lending. One of the I think the number one space that I got it wrong or wasn't really. What am I trying to say? I learned the most about is how flexible terms can really be. I'm like, oh, well, I guess I got to do 25% and we'll get a 20-year AM. And I think that's the space where I was, led to believe it was a little bit more structured than it is. Not in a bad way, but hey, if you sell your deal or if you do bring a good bit to the table as far as underwriting or multiple years of financials or projections or the renovation budget, how much the bank will help you in that regard too.
Where new investors can make mistakes, and I think this is something we talked about earlier. Yeah. If you're going to do a reno in this C class that you're going to try to convert to a B class property.
Or B to A, yeah.
Or B to A. Then, an investor who hasn't done this before, they may think, well, I got to do that out of pocket.
Yeah.
Right? I think you thought that.
100%.
Well, you don't have to do that, man.
Yeah.
I mean, you can if you want to. That makes it a better deal for the bank. You may get better terms if you try to leverage that. For example, if you say, okay, hey, bank, I'm going to put $250,000 into this of my own money on reno, and I'm also going to put $250,000 down. The asset's going to be that much better. Can you make your terms based on that scenario? We haven't talked about this yet. The answer is maybe. So I would say, hey, Matt, if you're going to do that, put your $250 that you're going to spend on the reno into an account at my bank. When you want to use it, let us be involved in the drawing of it, just like it was a loan. So we make sure that $250 is going in for a reno. Because if I'm going to give you terms on something that we expect to happen, then we need to have some sort of
collateral
of control with you, right?
So walk me through that one more time. So this is different than the line of credit that we would bundle in. Okay.
So let's say you say, all right, it's $1 million property.
Yeah.
And you're going to put $250 down on your down payment. So we're going to loan you $750. Right. And you say, Bill, we're also going to put $250 in it for reno, I don't want you to loan me the money for it. We're just going to do it. So we got 500 in on $1,250,000 total project. So that LTV, loan to value, loan to cost is going to be much lower than a traditional loan would be.
Sure.
So that risk drives terms
Yeah.
and rate.
Right.
And so if you say, hey, I'm going to do this, and because of that, I would like for you to really give me that really, really good rate, Bill. You know, and hey, I want that 25-year AM because we're putting all this in, or maybe it's a little bit longer. I'd say, hey, Matt, we can do that. But that 250 you're going to put in, and it's not that I don't trust you, it's that we need to document it, and we do this for the second guessers, not for you, not for me, well, for both of us, but more for the auditors that are going to pick these files up and look at them potentially.
Right.
So that 250 is going to go in a bank account at my bank, and when you start doing your reno, you and I we're going to be talking through this process. Hey, Bill, I need 100,000 of that 250 because we're putting a new roof on and floors, and they're doing it right now. Here's the invoices. And you just treat it almost like it's a loan, but it's your money.
Wow.
So if you want to leverage that type of equity into the deal to get better terms, we can do it that way.
That's crazy.
We just need to be involved with the process of how that 250 is being distributed back into the property.
Yeah.
Because we're giving you those terms based on that money going in.
Well, that opens a couple different windows, but I think that is the part that I was definitely I learned the most about, that you can change this. Or even the first position, second position, like that 12-unit deal we were working on whenever, 2 or 3 months ago. The seller was going to seller finance. They wanted 50% down, and even having the option to get half the money from the bank, putting 25% down on that half, and then the seller financing the rest at 3% in this current market, which was pretty nice too. But all of these avenues to say, I think the one thing being, whether you're a syndicator or you're the guy putting the deals together, or even a developer, there's no shortage. If you're in this seat, there's no shortage of negotiating. You got to negotiate with your investors, the guys putting money into the deal. You got to negotiate to get the property or to develop the deal. And then as soon as you get it to the goal line, you still have to negotiate with the bank a ton just to structure everything, which is the beauty of doing real estate or putting together big deals. But there's so much creativity on that side. You can't really learn in a book. You either learn from a really good lender that is willing to spend time with you, or you learn from someone else that's done it very, very well. But the rest, there's so much to gain from even that little conversation there that you don't really get to hear.
For the most part, well, not for the most part, all banks have loan policies. And we really like to adhere to those policies. If you adhere to the policies, there's not much can go wrong, right? I mean, it could.
Sure.
But it's less likely.
Yeah.
And I think across the board, you're going to find that most banks' policies are very similar when it comes to things like loan to value, loan to cost. On different asset types like raw land, you're going to be at 65%. Loan to value, loan to cost. Commercial real estate, if it's owner occupied, maybe you go up to 85%. If it's not, you like to be at 80%. Really, you want to push it down a little bit if you want a longer AM. And so I think that could be part of the conversation early on too for an investor with your banker.
Right.
What is your loan policy on this asset type? Because if you understand
that's interesting. Yeah.
Then
you can pitch it.
That's right.
Yeah. As long as it stays within the railways there. So to wrap up, and I don't know which deal you're going to talk about, but I want you to give an overview or share about a deal. It could be a large deal. It could be one of the best deals you've seen, a complex, unique, or a bad deal. But what is the most unique deal that you can share here?
Wow.
Without
I would have liked to have had that question ahead of time.
Yeah, I know. I thought that too. Figured I'd withhold it from you.
I'm not going to give you the obvious one that you're thinking about.
With the tiny homes?
Yeah, I'm going to go with something different. We may have talked about this in the past. I'm not sure if we have. I have a customer who's a hotelier, and he's based out of Canada, dual citizenship into the States. His brother lives in New York. They own this company together, and they have hotels up and down the East Coast. And their specialty is buying underperforming assets and rehabbing them, and then typically ramping up revenues and EBITDA over a 3 to 5 year period, and then they sell it, and then they go to the next asset. And they traditionally are, Marriott or Hilton type brands. They have an asset that is not a franchise property, but it is a one of a kind. And it's in Myrtle Beach. We lent money on that and built the relationship with these guys over like a 3 or 5 year period. Really, in the beginning, it was getting to know you terms, which is different than I know you terms. And so he was fine with that. He understood that. So we get through that. And, this was back in 2012 when people weren't lending money on really much of anything like this. And so, you walk along and you get to 2000 and I think it was 17. And the asset had overperformed any projection that he had given. And he came to us and wanted to, ask, hey, can I pull some equity out? That's always a no-no. We don't do that. We don't like to do that. We don't make habits of doing that. And the first question is, why do you want to do that? Well, I want to go buy something else. Well, we like to typically be involved with that part of it too. However, he'd not identified anything yet. So I'm talking to one of my senior credit analyst. I'm like, man, I think I would love to do this because I'm very comfortable with the borrower. I'm very comfortable with the collateral. But if we do this, essentially all their cash is out of the deal.
So were they refining the deal, or they just
were going
down to what?
They were going to refi cash out.
How much down to how much equity in the deal left?
None.
Okay.
Yep. However, we were still so I'll get to where we ended up. I asked the head of the credit team, have you seen anything like this before? And he said, you know what? We are in the middle of having these discussions on another deal. I'm like, well, how are they doing it? How are they even having these conversations? Right. Same thing, hotel class. They want to buy something else that we, the bank, have no idea how it performs. So to them, the thought was, hey, that's a bigger risk. That's a bigger risk.
Right.
We know what this asset does. We've seen the numbers for 5 years. We know what it does. I'd rather take the risk on this asset that we know, cash it out. We know our borrower. The money's going to be in our bank.
Sure.
We'll continue to have conversations. In fact, we'll probably be involved with what he's going to buy.
Correct. Yeah.
As long as if it's within a footprint of our geographic footprint that we want to participate in. I'm like, that's brilliant. So I said, can you let's talk some more, help me through this. And so I start building this plan, and then I start to kind of talk to the different approvers that are around me, not all at one time, but separately to get the feel for it. Got everybody on board. Now, so where we ended up, where we approved the loan, we cashed out to what he was asking as long as we maintained a 65% loan to value. In the hotel space, that's where you want to be. You don't want to be above 65%. Typically, if it's brand new, it's 65% loan to cost, loan to value, whichever's the lesser of the two. on a cash out, you definitely don't want to be above 65%. And the property appraised, and we cashed him out. Ultimately did a deal with that equity that he cashed out for a property that was up in the Northeast.
Oh, wow.
Mm-hmm.
So you were able to cash out. I thought you said he wanted to go all the way down to zero equity in the deal.
He did. So for example, let's say that he bought the property for $15 million.
Yeah.
He put $5 million in,
Yeah.
$10 million, loan was down to $7 million. He said, "Hey, I'd like to do this loan for $15 million."
Okay.
Which is what I bought it for.
Right.
We said, "We'll look at that." we ended up, we didn't, and 15 wasn't the number. I can't remember what we were probably a couple $100,000 off of what it was, which was no big deal to him. We stayed at our 65%. We were good.
Was any of that deal contingent on like the two loans running to get, like, were you banking on, what do you call it, cross collateralizing the loans? No. So it was, hey, we're going to do this for you. Trust that whatever happened, like, without knowing you're going to get the other deal. Interesting.
Yep. So we believe that much in the asset.
Yeah.
Where the location of the asset, the performance of the asset, the future of the asset. There was additional collateral that was undeveloped with the asset.
Yeah.
And then this hotelier was one of two hoteliers in all of the bank that were, our guys were like and at this point I was a 15-year banker. I'm working for guys that have been doing it for 30 years.
Right.
Like, these are the best hoteliers we've ever seen.
Wow. They bought that deal in 2012. They came for the refi in 17. Was that any bit contingent on the loan term coming due too? Or like, what was the loan term of that deal? And did they get an extended term after cashing out or what?
Yeah. It was, I think it was probably coming close to maturity. I don't think that's why they asked for that. It was just good timing where the market was. And they wanted to be set up for buying something else without having pressure of selling something they weren't ready to sell. Wow. And when we refi, if we refi to a cash out, typically we go ahead and adjust the term on that new rate.
I love that.
And we amortized it.
Good luck or good for that guy. I think we wrap up. It was the first good episode. Thanks for jumping on.
I enjoyed it.
You're the man.
Yeah.
Thanks, Bill.
Yep.